Disclaimer.
AG here, and yes, the irony is not lost on me that my initials are literally the periodic symbol for silver, which makes it especially awkward to tell you that 212 million ounces just vanished from markets you thought were safe. I've been tracking precious metals long enough to know when numbers stop making sense, and what's happening right now with silver has my attention in ways the 2008 crisis never did. Pop quiz: where's your silver right now? If you own silver certificates, ETFs, or futures contracts, you probably think your investment sits safely in a vault somewhere with your name on it. Here's what should grab our attention. Since January 1st, 2026, that assumption became dangerously wrong. Every ounce of refined silver passing through Chinese smelters now stays inside China's borders. Not most of it, not some percentage. Every single ounce. Think about what that means for a moment. China processes 70% of the world's refined silver supply. And starting 12 days ago, that entire river of metal started flowing in one direction only, straight into Chinese vaults that will never release it back to Western markets. Meanwhile, banks and financial institutions across New York and London owe 212 million ounces to investors who assumed the global supply chain would keep functioning exactly as it always had. They built their entire business model on silver moving freely between countries, between vaults, between buyers and sellers. That model just shattered like glass hitting concrete. But here's where the story gets darker, and this is something most investors don't realize until it's too late. Your silver isn't just sitting in a vault waiting patiently for you to claim it someday. It's being permanently consumed at a rate that would shock you if you saw the actual numbers. The solar panel industry alone devours 200 million ounces every single year, according to the Silver Institute's latest industrial demand report. Those panels get installed on rooftops across America, across Europe, across Asia, and that silver is gone forever. You can't melt down a solar panel and recover that silver economically. The metal gets permanently embedded in the photovoltaic cells, scattered across millions of installations in quantities too small to ever justify recovery. Electric vehicles present an even more troubling picture. Each EV battery contains silver components that manufacturers melt into the battery architecture during production. When that car eventually reaches end of life in 15 or 20 years, will anyone bother extracting tiny amounts of silver from a complex chemical battery structure? The recycling economics don't work, which means every ounce going into EVs might as well be getting buried in the desert. We are watching our industrial civilization consume our precious metals faster than miners can pull them from the ground, and most people have no idea this permanent destruction is accelerating. Then we have military consumption, and this detail should make every silver investor pause and recalculate their assumptions. A single Tomahawk cruise missile contains approximately $40,000 worth of silver in its guidance systems and electronic components, according to defense manufacturing analysis. Think about what happens to that silver when the missile reaches its target. It explodes, it vaporizes, it scatters into dust across whatever landscape it hits. That silver isn't coming back to markets. That silver isn't available for industrial use. That silver literally converts your investment into smoke and debris. How many missiles do we manufacture each year? How many does China manufacture? How many does Russia produce? Every single one of those weapon systems pulls silver out of the available supply permanently, and with global tensions rising, military silver consumption just keeps climbing higher. Your silver isn't competing just with jewelry demand or photography applications anymore. It's competing with national defense priorities. And governments will outbid you every single time when they need materials for weapon systems. Now let me show you something that reveals just how serious our supply crisis has already become, even before China's export ban, and even before Venezuela operations disrupted mining output. The COMEX vaults in New York, which serve as the backbone of global silver trading, held 400 million ounces of registered inventory back in 2020. That's metal available for delivery to investors who hold futures contracts and want to take physical possession instead of cash settlement. Fast forward to today, and those same vaults contain just 128 million ounces of registered silver. We lost 70% of available inventory in just 5 years. And here's the critical question nobody in the mainstream financial media seems willing to ask. Where did that silver go? It didn't vanish into thin air. It didn't get consumed by industrial demand alone. Someone with very deep pockets has been systematically pulling physical metal out of COMEX vaults, while everyone else holds paper certificates and assumes their silver sits safely in storage. You might be thinking this sounds like a typical supply-demand imbalance that markets will eventually correct. Here's why that comfortable assumption doesn't hold up anymore. Each ounce of physical silver in those COMEX vaults backs multiple paper claims. According to recent vault audit analysis, the average dilution ratio runs approximately 386 to 1. That means 386 different entities believe they own the exact same ounce of metal. When they all decide to take delivery simultaneously, what happens then? The banks running these vaults never expected everyone to show up at once demanding their physical metal. They built their system on the assumption that most investors would be satisfied with cash settlements, that most people would just trade their paper certificates back and forth without ever touching actual silver. That assumption worked beautifully for decades, generating enormous profits for financial institutions that could sell the same ounce hundreds of times over in pocket fees on every transaction. But something fundamental shifted in global markets over the past 2 years. Industrial buyers started demanding physical delivery because they actually need the metal to manufacture products. Solar companies can't build panels with paper certificates. Defense contractors can't make missiles with ETF shares. Suddenly, the banks face buyers who won't accept cash settlements, who absolutely require physical metal, and the vaults don't contain nearly enough inventory to satisfy everyone simultaneously. Venezuela's mining disruption simply accelerated a crisis that was already building toward an inevitable breaking point. China's export ban didn't create the shortage. It revealed the shortage that already existed, but remained hidden behind layers of paper contracts and financial engineering. We're now watching the moment when perception catches up with reality, when investors realize their paper silver might never convert to physical metal, when the gap between what's owed and what actually exists becomes impossible to ignore. Think about your own silver holdings for a moment. Do you physically possess the metal, or do you hold certificates, shares, or futures contracts? If it's the latter, you're trusting that when you eventually decide to convert paper to physical, sufficient inventory will be available at a reasonable price. The trust just became exponentially more expensive and possibly impossible to fulfill because the metal you thought was sitting in storage has already been consumed by industries that needed it urgently enough to outbid everyone else. The question isn't whether a silver shortage exists. The shortage is already here, confirmed by vault inventories dropping to decade lows, by lease rates spiking to levels that indicate extreme stress, by industrial buyers fighting each other for available supply. The real question is what happens next, and whether your paper claims will mean anything at all when the music stops and everyone rushes toward the exit at once. Let me show you something that doesn't usually make financial headlines, but tells us everything we need to know about where physical silver is actually moving. Flight tracking data from December 2025 reveals a pattern that should concern every Western investor holding paper silver positions. Cargo aircraft departures from Shanghai to Moscow increased 340% compared to the same period in 2024, according to commercial aviation monitoring services. These weren't passenger flights. These weren't general merchandise shipments. These were heavy cargo transports following routes that connect Chinese refining centers directly to Russian strategic storage facilities. Beijing's own storage facilities saw similar increases in inbound cargo traffic throughout December, with freight volume from southern Chinese smelting regions jumping to levels not seen since the pandemic supply chain disruptions. But here's what makes this pattern significant. Western vault inventories simultaneously dropped to decade lows during the exact same time frame. The London Bullion Market Association reported available silver inventory fell below 900 million ounces, the lowest level since 2015, while Eastern nations were adding an estimated 150 to 200 million ounces to strategic reserves that will never return to Western markets. Think about the logic here for a moment. Silver doesn't just disappear from one part of the world without reappearing somewhere else. The metal has to go somewhere. It has to be stored somewhere. It has to serve some purpose for whoever is accumulating it. When cargo planes fly refined silver from China to Russia, while London vaults simultaneously drain, we're not watching random market fluctuations. We're watching a calculated transfer of physical wealth from west to east, from paper systems to physical reserves, from markets that trust financial instruments to nations that trust only metal they can touch. Now, let me walk you through what happened on December 29th, because this single day proves everything I've been explaining about the gap between paper prices and physical reality. The CME Group, which operates the COMEX futures exchange where most silver trading occurs, announced an emergency margin requirement increase. They raised the amount of cash traders must deposit to maintain silver futures positions by 20% with less than 24 hours notice. When you're holding leveraged positions and suddenly need to deposit 20% more cash immediately, you face a brutal choice. Either inject more capital or liquidate your positions at whatever price the market offers. Retail investors holding long positions got crushed. Within 6 hours of the margin hike announcement, silver prices crashed 15%, falling from 84 per ounce down to $72. Liquidation algorithms triggered across the market as automated trading systems dumped positions to meet new margin requirements. According to futures market data compiled by the Commodity Futures Trading Commission, retail investors were forced to liquidate approximately $675 million in long positions during that session. They bought silver, expecting it to rise. They bet on the shortage becoming obvious to markets, and they got margin called out of their positions right before the shortage became impossible to ignore. 3 days later, something remarkable happened in Tokyo that reveals the true cost of that engineered price crash. Physical buyers in Japan, a spot silver market, paid $130 per ounce for actual metal they could take delivery of immediately. Let me repeat that number because it deserves your full attention. $130 per ounce for physical silver, while paper contracts in New York traded at $72. That is a 58 premium, a gap of more than 80% between paper and physical markets. What does this price divergence tell us? It means banks engineered a massive wealth transfer from small investors to institutional players who had the capital to grab physical metal at fire sale paper prices. Retail investors sold their futures contracts at $72 under forced liquidation, then watched large institutions convert those same contracts to physical delivery and immediately flip that metal to Asian buyers at $130. The banks did not just profit from the price swing, they profited from the spread between paper and physical, pocketing $58 per ounce, while retail investors absorbed all the losses. This wasn't the free market discovering fair prices through supply and demand. This was institutional manipulation using margin requirements as a weapon to shake out smaller players right before physical scarcity would have vindicated their positions. The timing wasn't coincidental. The margin hike came exactly when it would inflict maximum damage on retail investors and maximum profit opportunities for institutions with deep enough pockets to withstand temporary paper losses and secure physical metal. But here's what should really grab your attention, and this is where we see proof that the shortage existed long before China's export ban and long before Venezuela's mining disruption became public knowledge. London lease rates for silver spiked to 40% in October 2025, 3 months before either of those events hit the news cycle. Let me explain what lease rates actually measure and why 40% represents an absolutely critical stress signal. When industrial manufacturers or mints need physical silver but don't want to buy it outright, they can lease it from bullion banks. They borrow the metal, use it for manufacturing, then return equivalent silver later, plus interest. Normal lease rates typically run between 0.5% and 2% annually because silver is abundant and lenders face minimal risk. When lease rates spike to 40%, it means industrial buyers were so desperate for physical metal, they were willing to pay $40 in interest for every $100 worth of silver they borrowed. Think about what level of desperation that represents. Solar panel manufacturers were paying 40% interest to secure silver needed for production lines. Defense contractors were paying 40% to obtain metal for guidance systems. These aren't speculative investors gambling on price movements. These are operational businesses that absolutely require physical silver to manufacture products, and they were willing to pay loan shark interest rates because they couldn't secure metal through normal channels at any reasonable cost. The Solar Energy Industries Association reported in late 2025 that panel production delays had increased by 65% compared to the previous year, with silver supply constraints cited as the primary bottleneck. Battery manufacturers faced similar shortages, according to industry trade publications, tracking electric vehicle supply chains. Everyone who actually needs silver for real-world applications discovered simultaneously that available inventory had become dangerously tight, that the comfortable surplus they'd relied on for decades had evaporated, that competition for available ounces was about to become cutthroat. Those October lease rate spikes happened before China announced its export restrictions. They happened before the Venezuela situation disrupted South American mining output. They happened before mainstream financial media started covering silver shortages. This proves the crisis was already building, already reaching critical levels, already forcing industrial buyers to compete desperately for shrinking supplies. China's export ban didn't create the shortage. It simply eliminated the last remaining source that Western markets were counting on to bridge the gap between available supply and demand. Now connect all these data points together and see the pattern that emerges. Eastern cargo flights increased while Western vaults drained. Paper prices crashed on forced liquidation while physical buyers paid massive premiums. Lease rates spiked months before public awareness. Each piece of evidence points to the same conclusion. Physical silver has been disappearing from Western control for months or even years, accumulating in Eastern reserves that won't release it back to our markets, while our financial system continues selling paper certificates that claim to represent metal that no longer exists in accessible locations. You might be wondering why Eastern nations would want to accumulate such massive silver reserves. The answer connects to industrial strategy, monetary policy, and geopolitical positioning. Silver isn't just a precious metal, it's a critical industrial commodity required for solar panels, electric vehicles, 5G infrastructure, military electronics, and countless other technologies defining the 21st century economy. China recognized this strategic importance years ago and began systematically securing physical supplies, while Western investors remained satisfied with paper exposure. The World Silver Survey, published by the Silver Institute, shows China consumed 220 million ounces of silver in 2024 alone, primarily for industrial applications supporting their massive renewable energy build-out and electronics manufacturing dominance. They're not accumulating silver to sell it back to us later at higher prices. They're accumulating silver because they understand their entire industrial modernization strategy depends on securing critical materials before global competition makes those materials unobtainable at any price. Russia's involvement adds another dimension to this strategic accumulation. Facing Western sanctions and financial restrictions, they've been converting dollar reserves into hard assets, including precious metals. The Central Bank of Russia reported increasing precious metal reserves throughout 2024 and 2025. Those specific silver holdings remain less transparent than their gold purchases. Silver offers them a way to store value outside the Western financial system, while also securing materials needed for their own defense manufacturing and technology sectors. Meanwhile, our vaults keep draining, our paper markets keep trading the same ounces hundreds of times over, and our investors keep assuming they'll be able to convert certificates to physical metal whenever they decide the timing is right. That assumption is about to face its harshest test yet, and based on everything we're seeing in cargo flight patterns, vault inventories, lease rates, and price premiums, a lot of investors are going to discover their paper. Silver won't convert to physical metal at any price they're willing to pay. Tomorrow morning, January 6th, 2026, marks the COMEX delivery deadline for January futures contracts, and the mathematics of this deadline should concern every silver investor holding paper positions. Contracts representing 84 million ounces are scheduled for delivery, but registered vault inventory available to satisfy those deliveries falls dangerously short. According to COMEX warehouse reports updated through January 3rd, actual available supply for new deliveries is closer to 40 million ounces, creating a shortfall of 44 million ounces between what's owed and what exists. Every contract that gets cash settled instead of physically delivered represents proof that your paper silver has no metal backing it. The contract holders wanted physical silver. They paid for physical silver. They have legal claims to physical silver, but the vaults simply don't contain enough inventory to honor those claims. Here's what makes tomorrow's deadline so critical. It's the first major delivery date since China implemented its export restrictions. The 70% of global refining capacity that China controls is now completely unavailable to Western buyers, which means tomorrow's delivery squeeze has no relief valve, no backup supply source, no way to paper over the shortage with last-minute metal imports. Watch what happens to the premium gap between paper and physical prices over the next 48 hours. Right now, paper silver trades around $71 per ounce on COMEX futures, while physical buyers in Asian markets pay $130 for immediate delivery. That's an 83% premium for physical over paper. When tomorrow's delivery failures become public knowledge, when investors realize the exchange is settling contracts in cash because metal doesn't exist, that premium gap is going to explode to 200% or even 300% within days as panic spreads through markets. Think about what that means for your investment position. If you hold silver ETFs or futures contracts, you own paper claims trading at $71. If you decide tomorrow that you want to convert those paper claims to physical metal you can actually possess, you'll discover the real cost is $140, $180, possibly $200 or more depending on how fast premiums spike. Your paper investment just lost 60% to 70% of its value the moment you try to access real silver. But the delivery deadline squeeze is just the beginning of our mathematical problems. The solar panel industry will consume the entire 2026 mine supply deficit before a single investor gets metal. Global mine supply for 2026 is projected at approximately 820 million ounces based on current production rates. Industrial demand across all sectors is projected at approximately 915 million ounces for the same period. That's a deficit of 95 million ounces, and the solar industry alone could consume that entire gap. Here's why industrial buyers win every bidding war. A solar panel is worth $50,000 installed on a commercial rooftop. If that panel requires 20 ounces of silver to manufacture, the solar company can justify paying $200, $300, even $500 per ounce because their final product still generates massive profit margins. Defense contractors face similar mathematics with even higher urgency. A Tomahawk cruise missile costs approximately $2 million to produce and contains about $40,000 worth of silver. If silver prices spike to $200 per ounce, does that stop the Pentagon from ordering missiles when national security requires them? Of course not. This is why your $71 paper claim loses to industrial $200 physical bids every single time. You're competing against buyers who need silver for products worth tens of thousands or millions of dollars each. They have deeper pockets, stronger balance sheets, and existential reasons to secure physical metal regardless of price. Now let me show you the truly terrifying calculation that reveals why this shortage becomes mathematically impossible to solve. The Silver Institute estimates the cumulative supply deficit over the past 5 years at approximately 820 million ounces. That means from 2021 through 2025, industrial demand exceeded mine supply by 820 million ounces total. Here's the problem. 820 million ounces represents more silver than currently exists in all Western vaults combined. Add up all publicly reported Western silver inventories, and you get somewhere between 1.8 and 2 billion ounces, depending on what you count as available supply. That deficit continues into 2026 and beyond as solar installations accelerate, as EV production ramps up, as military demand increases with rising global tensions. We're on track for another 95 to 200 million ounce deficit this year, then another deficit next year, then another the year after that. At current consumption rates, Western vaults face depletion within 5 to 7 years. But the crisis hits long before vaults actually run empty because markets panic when they see the trajectory, when they realize the math doesn't work, when institutional buyers start hoarding metal before it becomes completely unavailable. March 2026 brings the next major COMEX delivery deadline, and based on open interest in March contracts, we're looking at potential delivery requests for another 60 to 80 million ounces. The vaults that barely managed to scrape together enough metal for tomorrow's January delivery will face another major test in just 8 weeks. Then May contracts deliver in April. Then July contracts deliver in June. Each delivery period pulls more physical metal out of vault inventory. And each month, China's export restrictions prevent new refined supply from replenishing Western stocks. Here's the final calculation that should concern every silver investor. When a crisis becomes mathematically inevitable, who gets to the vault first matters more than who has the strongest claim. The major banks received $34 billion in Fed bailouts and support during the 2023 banking crisis, according to Federal Reserve Emergency Lending Facility disclosures. Those same banks operate as authorized participants in silver ETFs, as clearing members for COMEX futures, as vault operators storing physical metal. When vaults can't satisfy all claimants, which investors do you think get priority access to remaining physical inventory? The retail investor holding 100 ounces in paper certificates, or the institutional bank with government backing and direct vault access? This isn't about creating panic. This is about understanding mathematical realities that exist regardless of whether we acknowledge them. The shortage is already here, confirmed by every metric we can measure. Vault inventory is declining, lease rates spiking, price premiums exploding, industrial buyers competing desperately for available supply. So what do you do with this information? First, understand the difference between paper silver and physical silver. Paper claims are convenient and liquid right up until the moment you actually want metal. Physical silver represents metal you actually possess that nobody can cash settle away from you. Second, recognize that price matters less than availability. A $50 an ounce you can't obtain is worthless compared to a 150 ounce sitting in your possession. Third, accept that the comfortable assumptions supporting silver markets for decades no longer hold true. We're living through a historic shift in precious metals, markets where Eastern accumulation meets Western paper systems, where industrial consumption exceeds mining production, where financial engineering crashes into physical reality. Your silver isn't sitting safely in a vault with your name on it. Your silver is getting consumed in solar panels, melted into EV batteries, and converted into missiles. Your silver is being claimed by 386 other paper certificate holders who believe they own the same ounce you do. Your silver is moving on cargo planes from Shanghai to Moscow, while Western vaults drain to decade lows. The mathematics say not everyone gets their metal, which means your decision about whether to hold paper or physical is not just an investment strategy. It's a race against time to convert claims into actual ounces before the vaults run dry and you're left holding worthless certificates backed by nothing but broken promises. Tomorrow's delivery deadline is just the beginning. Watch what happens when paper prices and physical reality finally collide. If you made it this far, you're exactly the kind of person who deserves to know these numbers before everyone else figures them out. Hit that subscribe button so you don't miss what happens when the March delivery hits and the real panic starts. And remember, AG doesn't just stand for Asian guy, it's also the chemical symbol for the metal that might just expose the biggest financial illusion of our generation.